my heart wants there to be lower interest rates now, right? We can't help it being in the business, but my brain tells me that we've got till 2025 before the Federal Reserve does anything to affect the bond market.
This
Okay.
is Mike and Mike. This is your Thursday weekly rendezvous to talk about mortgages and real estate. Today, we're touching on a little bit on the direction of being a loan officer and how you can make money in this industry more than real estate without even doing a transaction. And it might be important because Michael is going to talk to us about Mike's going to talk about the Fed minutes, and then it seemed like Logan said John Bliss claims are more important. And by the way, starting next week, now that this is our first week over on Discord, we're going to start having guests and more reasons for people to join throughout the show. I will be at Digital Mortgage, so I'll be able to report back from that. Mike, you want to just talk about the Fed? I think that's why. I don't think we can not talk about it. And it sounds like I'll let you talk, and then I won't even say what it sounds like.
Well, actually, for the last 2 days, I was over at the IMN Information Network multifamily conference, and I saw what the Federal Reserve, when they basically did what everybody thought they were going to do. It's a whole lot of nothing. And of course, everybody's listening to not what they're doing, but they're listening for what is it that they're going to do. And the thing about it that's super interesting is if they can't, they're going to tell you, number one, that they're looking to curb inflation. Number two, they're looking to not destroy the job market. And then number three, they're looking to figure out what is it they can do to fix the economy without destroying it, without telegraphing what they're going to do. Because it's kind of like if you're a loan officer and you're afraid of telemarketing, or if you're a realtor and you're afraid of telemarketing, and you sit there and go, I'm not going to telemarket. Why? Because if I go and telemarket, they're going to hang up on me, and I'm never going to get any clients because they're going to keep hanging up on me. And the thing about it is that you don't know if they're going to hang up on you, and you don't know if they're going to say yes or no, and you don't know what they're going to do, and you don't know what that future person is going to do. And in the same sense, if the Federal Reserve is going to would just tell you what they're going to keep doing, then the bond market would react accordingly. They would buy and sell mortgage-backed securities accordingly, and now you can predict where interest rates are going. So that's why it's always so cryptic on what is it that they're saying, what is it that they're telegraphing on doing, and so that's why it's always a guess on, are they going to raise or lower interest rates. So we're going to see what's going to happen at the next meeting, but I think what's going to happen is they're going to keep holding. They're not going to raise it again, I don't think, until next year. And I think they're going to raise it sometime in the spring or summer of next year. A lot of people are saying maybe a little bit earlier. I tend to disagree. I think that they're still waiting to see, how is inflation going to do? How is this strategic petroleum reserve thing going to affect inflation? As we head into the winter, heating oil is kind of a big deal. The price of gasoline is going to be increasing. Is that going to affect the inflation number? Is that going to affect the ability for the household or the consumer for them to be able to have disposable income? So some of these things that we don't necessarily see at the moment, are we going to be able to say, is this going to affect inflation? Is it going to affect wages and lack of wage growth? And is it going to cause consumer spending to increase, decrease? We actually don't know all these things, right? We could have consumer spending increasing, but because of the cost of fuel cost. So you might see your vegetables begin to increase in cost, your gasoline begin to increase in cost, and even more so, the cost of insurance. My insurance.
Let's slow this down because we got a little bit of an audience here now on LinkedIn audio, right? I think people
Sure.
really care about this. So the Fed knows that the general public wants them to stop raising rates, or even, let's talk about raising rates. They want better commentary that what goes up must come down and everything is going to be okay. and everybody needs it now in this instant gratification world. I think what economists do very well is they zoom out, right? They look at things over 2 years, 5 years, 10 years. So what
That's
feels
right.
like a long pressure cooker here, like a horrible 2022, not only a horrible. Mike's going to talk about the Fed minutes, and then it seemed like Logan said jobless claims are more important. And by the way, starting next week, now that this is our first week over on Discord, we're going to start having guests and more reasons for people to join throughout the show. I will be at Digital Mortgage, so I'll be able to report back from that. Mike, you want to just talk about the Fed? I think that's why. I don't think we can not talk about it. And it sounds like I'll let you talk, and then I won't even say what it sounds like.
Well, actually, for the last 2 days, I was over at the IMN Information Network multifamily conference, and I saw what the Federal Reserve, when they basically did what everybody thought they were going to do. It's a whole lot of nothing. And of course, everybody's listening to not what they're doing, but they're listening for what is it that they're going to do. And the thing about it that's super interesting is if they can't, they're going to tell you, number one, that they're looking to curb inflation. Number two, they're looking to not destroy the job market. And then number three, they're looking to figure out what is it they can do to fix the economy without destroying it, without telegraphing what they're going to do. Because it's kind of like if you're a loan officer and you're afraid of telemarketing, or if you're a realtor and you're afraid of telemarketing, and you sit there and go, I'm not going to telemarket. Why? Because if I go and telemarket, they're going to hang up on me, and I'm never going to get any clients because they're going to keep hanging up on me. And the thing about it is that you don't know if they're going to hang up on you, and you don't know if they're going to say yes or no, and you don't know what they're going to do, and you don't know what that future person is going to do. And in the same sense, if the Federal Reserve is going would just tell you what they're going to keep doing, then the bond market would react accordingly. They would buy and sell mortgage-backed securities accordingly, and now you can predict where interest rates are going. So that's why it's always so cryptic on what is it that they're saying, what is it that they're telegraphing on doing, and so that's why it's always a guess on, are they going to raise or lower interest rates. So we're going to see what's going to happen at the next meeting, but I think what's going to happen is they're going to keep holding. They're not going to raise it again, I don't think, until next year. And I think they're going to raise it sometime in the spring or summer of next year. A lot of people are saying maybe a little bit earlier. I tend to disagree. I think that they're still waiting to see, how is inflation going to do? How is this strategic petroleum reserve thing going to affect inflation? As we head into the winter, heating oil is kind of a big deal. The price of gasoline is going to be increasing. Is that going to affect the inflation number? Is that going to affect the ability for the household or the consumer for them to be able to have disposable income? So some of these things that we don't necessarily see at the moment, are we going to be able to say, is this going to affect inflation? Is it going to
2022 for lenders, but a horrible 2022 with great predictions by now, let's say. So that never came. 2023 was a little bit more realistic, but they were hoping that in 2024 it would be better. So it's not even about the rate cuts. I guess it's about the commentary, and what you're describing goes along with that commentary. So do you just want to back up and slow it down a little bit as far as I mean that in a good way. Like, people would prefer fast. We're kind of radio talkers, but you're saying, I guess when I say slow it down, like, okay, Johnny American that's in somebody's My Pipeline, when they think about being a mortgage coach, financial advisor, has 770 credit score, 401k, 3% rate. Should they go to 7%? Has to look at HELOC options, maybe, which program's better? Is there a non-QM? Whereas, I think what the Fed looks at is farmer in Alabama, right? Coal miner in West Virginia that can't make more than $18 unless he works overtime, which is $26 taxed an hour, walks home with 14, stops at the convenience store, a can of Coke, 2 bags of Doritos, and a candy bar now comes to about $18, right?
Sure.
You can't walk out of CVS without a mile-long receipt and a $40 payment, even if you just bought 3 things. It's just impossible. And that's a lot of hours for those coal miners I just spoke about, for that graphic designer in New York who has no money after their rent. For those people, Mike, what do you like? I guess repeat about the cost of insurance and more of like the requirements around.
Let's talk about Main Street just for a second here. When I'm watching I'm briefly watching the United Auto Workers strike right now, and anytime I see things like that are happening, I'm not going to compare it to what has happened 10, 15 years ago. I'm not going to compare it to what's happened 40 years ago, the last time that we saw high inflation. But what I do look at is the average household trying to figure out how to make their financial ends meet. And if the common worker that's in Midwest America is trying to figure out, hey, you know what? The cost of fuel, the cost of raising kids, just the cost of living is beginning to increase, and it's now affecting my ability to play, to send my kids to Pop Warner, or play or football camp or whatever. And it's now affecting their ability to not even just go on vacation, but just go day-to-day living. And they have to tap into their credit cards for that purpose. And we're looking at credit card expenditures increasing over the course of time. I'm looking at some kind of like what I think is canary in the coal mine, common sense items, and saying, hey, credit card spending is increasing. Fuel prices are going to increase even more because I'm watching this. I think we had
because of the winter.
Because of what?
Because of the winter coming, or just something
No,
macro?
last year, President Biden released more of the strategic petroleum reserve to keep fuel prices down. And I think last month we added 600,000 barrels back into the reserve, but we still need to add like 23 billion barrels back into the reserve. And if you think of 23 billion barrels versus last month, we only added 600,000. That's a lot of oil that we got to add in. I mean, if you're watching the oil's futures right now, like I'm watching right now, people are
And we're
buying.
a country that doesn't like fossil fuels to begin with, so it's not like we can get it ourselves, right? So we're relying on.
That's right.
It's almost like we're playing poker, and there's a mirror behind us, and we're wondering why we're losing money. Like we're tipping everybody off, right?
Yeah, it's like a refi boom for the oil companies right now, right? You sit there and go, because during the refi boom, rates kept coming down, so bond prices kept going up. So hey, let's keep making money on mortgage-backed securities. In the oil industry, oil prices keep going up, so they keep buying oil futures. Meanwhile, they're making money on their oil futures contracts because oil prices keep going up, right? So it's their refinance boom period, but that also means that it's a lead into inflation. Okay, we're not really following that for real estate and mortgage purposes. I more follow that as just a general economist, just looking at that, going, okay, if that, if we look at inflation, but we look at beyond the housing cost, beyond what are we going to be spending money on? We drive to the store, or even if we don't drive to the store and we buy things on Instacart or UPS and Amazon, this, that, and the other, those things take fuel too. So the cost of fuel is going to affect our general ability just to live. Now, I live in Southern California where you drive everywhere. I don't know what it's like for you in Boston, Michael, but
Except LA. In LA, you don't drive, right? You got to be, but yeah, I guess Southern California. In Boston, we definitely drive, but we've had a tunnel close, like a major tunnel that gets everybody north of Boston into Boston, and so they've given a bunch of public transportation for free, but it just it's a nightmare. They're finally opening it again, and traffic's terrible. I mean, it's the problem of modern America, right? That Oliver Anthony guy is just absolutely amazing. He sings a song called "I Want to Go Home." But it's
yeah,
like fourth generation farmer, right? Grandkid sells the farm to an out of towner. 2 days
yep,
later, trees are going down, concrete going everywhere. From where I am to like 4 miles into Boston, they are putting at least 3,800 new apartments. So you can imagine the amount of traffic, right? So
that's
there's
interesting
money,
that you
like,
say
and
that.
there's people. I mean, and everything's expensive. All these apartments are in what were bad areas. They're all going to be $4,800 brand new built apartments. None of them are going to be condos. Those are all potential home buyers down the road. I don't think the industry's overly in trouble. I think the CEO of PennyMac said it well. They've seen 50 to 70% drop in volume for top 30 lenders, but only 18% reduction in workforce. Obviously, huge problem. A big problem for that probably was optimism. They are looking at people like Ryan Hills has Jim Deach on their Moneyball and sort of his program on who I worked with for a while, and I got to see like exactly who people should be cutting in the industry. The lenders don't want to hear it. All these experts think they know why, but they don't. It's a lot of like gut feel, right? Like not everybody's Billy Bean. There's people that can say that I don't care what the stats say, that kid can't hit. And there's more to it. You might be hanging on to two production branches that make up 70% of your volume. You don't want to introduce any change, because if they got rear-ended that day pulling out of the Dunkin' Donuts on the way into work, then they couldn't upload their documents because of a change that the vendor sold on 18% efficiency, and I'm sure it is. I mean, it is, but it just required a name change folder in Encompass. Not a big deal, right? Well,
Yeah.
it is for Tommy Loan Officer now, because he got rear-ended. He can't upload there. Then he goes to fill out another field, and there's just a new little change for there's an automated underwriter now, and the process is to fill out a certain field before the loan officer can edit it. Again, another 30 bips it can save. But Tommy, now he's getting real upset. Bank, 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 bank. He's got a $14,000 offer over at another company, but it requires 6-month commitment. 14,000 is nothing for him. It's a couple deals. He's never done it. Goes out to lunch, spilled some ketchup on his shirt. That's it. I'm going. Thinks about that bill coming up, and I'm just going to take the 14,000. I'm going to go over here. That is what
Is it
people
even
are.
worth it though, Michael? If
Wait,
let's
just to
say,
land this plane.
all right, go for it.
The lender, though, that just lost Tommy,
Yeah,
Tommy and one other branch made 70%. So now that lender owner not only lost a lot of business, over 30% of their volume, let's say, but
right.
now they work for the other person that makes up the rest of it now, right? Because without that person, they're cooked. So they have to go find another person to. And so I think that whole piece there, is why lenders have not cut down, I would say. But how they can sleep at night not cutting down is the optimism of, like Barry just went on Ryan Hillis' show and said, no, Moneyball's not right. This is possibly what could happen where rates could go down. And then you see not just a Fed meeting, but I saw a post on, if you could maybe explain this, but we are in so much debt that they almost need to sell, I think what it was like $1.9 trillion of bonds, and that means there's just so much bonds out there
Are you talking about the
that
United States debt, the national debt?
yeah, I read like that's one of the reasons that the 10-year still goes up too, is because we are selling so much of it that there's so much supply
Right.
that the prices have to be higher to get rid of it. So
Yeah, but a lot of this debt is still short-term debt right now, right? We still have this inverted yield curve, which of course means that short-term yields are higher than long-term yields, because in order to try and find out, hey, can we get some short-term investment right now so that we can get that guaranteed investment, not knowing where long-term yields are supposed to be. And if that is currently the case, what I'm hearing right now on behind certain closed doors is that there's still an appetite for the long-term yield, but they just still want to be able to see, hey, what is the Federal Reserve saying? This is going to go back to what we were talking about originally, is what does the Federal Reserve want to do, right? And if they are going to hold and then raise and then potentially drop in maybe 2025, then hey, now we've got some runway of going, okay, this is how we're going to, if you're hedging in capital markets, now you're figuring out, okay, we've got about 20 months of kind of up and down, up and down, up and down, but traditionally a drop in price. But then it's really going to go back gangbusters when the Federal Reserve begins to drop their overnight lending rate. And
is that your prediction? Like, where should we be looking? Should we be looking at like your oil prices? Should we be like obviously everywhere, but like, where do you think the market's looking, because that's what they've done for the last 30 years, and where do you think maybe they should be looking because it's a totally different market?
I talk to a lot of people, not just in mortgage, but in, I'll call it, financial services. I think we've got. I would. My heart wants there to be lower interest rates now, right? We can't help it being in the business, but my brain tells me that we've got till 2025 before the Federal Reserve does anything to affect the bond market, the mortgage-backed security market, I should say, to where we actually can see significant change in a drop in interest rates. We may see we may see plus or minus 100 basis points in mortgage-backed securities over the course of the next year or so. But it's not like we're going to see like 200, 300 point swings, unless, of course, there is a major world calamity, war, attack, which could happen, but I hope it doesn't happen. But unless something like that does happen, maybe plus or minus 100 basis points up or down in any point in time. And 2025 is where I think it's where we're going to be able to land the interest rate plane. But
we needed that. And just so everybody knows, we are Mike and Mike. This is our 11th episode. If you were on Discord, you would know it. We are actually moving the show as far as interactions go over to Discord. We got Christine and Sue from Sue Knows Best. So if anybody wants to go over to Discord and ask her a question about credit, about the new Vantage score, about where she sees consumers, about cash out refinance opportunities, maybe where she would aggregate leads from, I am trying to message most of you through LinkedIn to get the link over to there. You're welcome to listen here on LinkedIn audio, but on Discord is where we're creating the community. If you're in Discord, please take the time, look around to give this station a follow. It will really impact our ability to go out and get sponsors. If we can get 15 subscribers, 30 subscribers, that's actually a lot for where we are. Our focus is going to be a lot on driving loan officers to this channel so that they can tell us what's going on in the streets. I think we need to hear that. And then I can tell you what's going on talking to the C-level of lenders, as I do it every day. I spoke to 3 this week. One is a top 10 lender. If Christine or Sue wants to come up here, because you guys are the 2 on Discord, we'd love to have you up to prove a point that we do take people raising their hands over here on our new community station. But as you can see, Mike, we have a good handful of people. Here's Sue. Hi, Sue.
Yeah. By the way, I don't know. Do we still want to take on callers or questions? Breon Walker down in the LinkedIn audience raised his hand and stuff. But Sue, you're on here with us on Discord. It's good to see you here.
Yeah. Hey guys. Hopefully you can hear me okay.
Yes.
Okay, perfect. So thanks. I did get on Discord, and trust me, folks, if I can do it, anybody can. So nice to see your new platform, and kind of an interesting thing. I've been playing a little bit with the Discord today. I see we've got other folks out there on the LinkedIn, and I joined the audio on LinkedIn before. And as Michael said earlier, Mike, I've got Mike and Mike here, but as Mike Kelleher said, if you have any questions that are score related or questions about the FHFA credit report and score changes, that if Michael's predictions are right about interest rates, we're going to have a tsunami of lower rates and credit score and credit report changes coming in 2025. So could be an interesting time in our market.
I think so.
So, Mike, when in 2025 do you think people will start preparing for? Do you think it'll be like a fast drop, or do you think the market's a little bit rigged and like they don't want obviously all those pools to just be leaking? Everybody falling out at once or recaptures. Do you think it'll trickle down, and then when do you see that? And I think what I'm trying to get at is then, Sue, when in 2025 will lenders really start, like, is it going to be mandated, or will it be adopted, some of these, to have better strategies to close more market share than others?
This is super interesting to me because if you're in lending right now, and in other words, if you're a loan officer or even a realtor for that matter, or anybody who's in mortgage or real estate, and you're basically living month to month either on credit cards or dwindling your savings because of the current marketplace conditions, or maybe you went from a 700 score down to a 600 score down, or 600 down to a 500. Right now is that time to figure out, hey, you've got 18 months to figure out what are you going to do with your income, your credit. And if you didn't buy yet, you still have that opportunity again to come up in the next year and a half to go, you know what, 18 months really isn't that far away. Let's see what we can do to increase our probability and mitigate against some of the future evils, and eat some beans now so we can have some steak in the future, right? It's the whole, we can do some things now and do some credit issues. Maybe it's debt consol. Maybe pay down some debt. Pay a little bit high interest rate today, so when the interest rates really do fall, you'll have that higher score. Maybe it is as quick as a fix as doing a HELOC to pay down your credit card debt. Maybe it's and I don't know if it's going to be a collections issue. Medical collections aren't reported anymore. But talking to someone like Sue, or getting your company to talk to someone like Sue, where she can give some practical advice on how to get ready for the next refinance boom, or even the next purchase boom. I mean, the only reason we don't have this boom right now is inventory.
I don't see a purchase boom. I think you're right. It's going to be a cash out refinance boom, and it's going to be asking Sue what we should be looking at as points that we're trying to stress to them. Do it now before it's too late. And I don't even mean improving credit. Like, there has to be points where, a 30-day late's okay, but not a 60-day late. Like, they're going to need a little bit of a nudge to get off of their 3.3% mortgage. But I think you're seeing it, right, Sue? There's a lot of reasons to get off of it right now. Like,
Yeah,
what's the average amount that people owe on their credit card? Because I think most people assume it's like $7,000. I feel like it's much higher.
It's around 7,000. The younger they are, usually the higher the balance. The older they are, the less the balance. So that's kind of the rule of thumb that it is. But what I'm seeing right now is people who are saying, I don't want to buy because of 7.5% interest or what have you. But they're sitting there with a ton of credit card debt and perhaps student loan debt. And they're not thinking about their actual interest rate that they're paying. So even if you're sitting in your 3%, current mortgage, and you've got $200,000 in equity, and you're not going to sell, why are you also sitting there with credit cards maxed out? And like Michael said, kind of sitting there eating beans. You're living to pay someone else interest. And that interest is not tax deductible, which is another thing that blows my mind, right? Because those tax laws changed, and you're sitting there in your home, and you don't want to move, and you don't want to sell. And quite honestly, the whole idea of, if I sell, then I'm going to add inventory. Well, no, you're not, because it's generally a 1-for-1. How many homeowners sell and go to a renter's market? I know, Michael, you talked about that on a few shows ago. It's unusual. So people selling out their 3%, to cash out doesn't really make sense for a lot of people. But if you're making a car loan and you're paying interest on that, and you've got 2 or 3 credit cards at 26, 27, 28, interest rate keeps going up on those, then you need to look at your net interest and look at a cash out refinance. If I were originating today, I did that 20 years ago, those would be the conversations I would be having, is let's talk about what do you want to do over the next 5 years, not tomorrow, not next year, but where do you want to be in the next 5 years financially? And let's take a look at your situation. If you're sitting on a ton of equity, you shouldn't be sitting on a ton of debt as well.
And that is the number one exercise that I think it's like psychologists or scientists or whatever the people that are willing to map out their next 5 years almost always have a more successful next 5 years. It's just a difficult action to do. I was just watching a podcast. There's programs around it, but if you actually had the ability as a loan officer to walk somebody through their next 5 years, and anytime you see a point of pain, you do them a service and dig a little bit deeper. How does that make you feel? What kind of opportunities did you lose because of that? How much do you think that cost you? What did you try to do about it? When that didn't work, what did you try and do about it?
Is that a tough conversation to have with your past client? You know, you help them with their purchase loan or their refinance loan into a 2.5, a 2.7, a 3.2, and then you give them a call back. You come to find out that one of the spouses got laid off, or instead of, even differently, it's not a matter of something bad happening to a family. It's one of the members went from high school to college, and they didn't prepare properly for their 529 plan or their kids' school, and their expenses went from whatever, let's say it was $7,000 a month to $12,000 a month because of tuition and rent and books and
That's a lot.
whatever,
Yeah.
right?
Yeah, but
And
the
it wasn't
answer is
even
yes.
it wasn't even a matter
Like,
of it was just expenses increasing, and now they're dipping into their savings. So
like the answer though is yes. It's a very difficult conversation to have with past clients. It's a very difficult conversation to have with the orthodontist you see every Wednesday at Rotary about how his spouse lost their job. It's very difficult to have somebody do a 5-year plan when you haven't done a 5-year plan in your last 10 years. Why, if you're not even comfortable enough to do it with yourself, how are you going to pick up the phone 75 times a day for 100 straight days and do it when you've been so used to working from home, doing the laundry, getting on your computer, getting somebody from a 4.25 down to a 3.875, going through 6 months later, 3.875 down to 3.25. I would say it's very hard, very awkward.
It is awkward, but quite honestly, that's the gig today. And that's what it's going to be in the future. The loan officer of the future, the successful loan officers, the ones that are going to make it through this market and be successful, are not starting off their conversations with, well, let me go ahead and get your name, address, and social security number. We'll pull your credit. We see where we go. That's done. Those days are
Or
over.
how about this one, Sue? Can we do a year review? Like, what's the difference, do you think, between doing a year review of somebody's house situation versus just trying to check in on them and get to the point that they're falling behind and ask about that pain and what their 5-year plan is?
I mean,
think
that's a great point to do. If you close a loan with someone, you should be touching base with them in 6 months, 9 months, a year, because a lot of people, especially first-time home buyers, they don't understand the cost of home ownership. And even with a home warranty, things happen, costs go up, and they start looking at other, financial vehicles. One other thing I wanted to say is, we're seeing in our industry, because of the right sizing, our own people who are losing their homes, losing their cars, exhausting their credit cards because they cannot find work. And the catch 22 of that is all of those things that are affecting their credit report will affect their ability to get another job in the financial services industry. So I just wanted to make that point. I'm going to have to hop off, guys, but
Wait, Sue, before you hop off, just give
yeah,
yourself a real quick plug for everybody. You speak to lenders. Is that what you're looking for to talk to
So
their audience?
actually, I don't have anything to plug, Mike. It's a
Okay.
crazy thing. I've been in the mortgage credit space for almost 39 years. I have a presence on LinkedIn under Sue Knows a Score. I do not monetize what I'm doing. I'm simply trying to help our industry understand the business that I was fortunate enough to grow up in. Beyond that, I work with Next Mortgage Events as a business development, and I take limited contract work for folks who are maybe looking for a variety of services that I can help with. But I'm not a credit counselor. I don't do credit repair. I'm simply someone who, like I said, who spent nearly 40 years in the mortgage credit space, and I try to share what I know.
awesome.
Thank you.
So, have you heard the saying, asking for permission to reject me? Have you heard that before, Michael?
I don't know. It sounds very effective. I'll say that. So I guess not.
So, because what a lot of loan officers don't do is they don't ask the question. Is it okay if I ask you a few questions, and if they're too personal, just go ahead and let me know. Is that okay? It's called permission to reject, right? And I think that the loan officer maybe they were so used to saying, hey, what I used to call job bank. Hey, what's your name? What's your job? What's your bank account information? Collect the reserves, and then, hey, this is your lowest rate, and call it a day. And I think it's kind of time right now to get to ask for permission for rejection, meaning that, is it okay if I ask you a few questions, and if they're going to be too personal, just go ahead and let me know. But what I'm doing now is I'm just reaching out to you to see, hey, not only how is it going, but what's happened in your, is there anything that's happened in your life that we might be able to counsel you on? Because I had a tough conversation with a past client about 3 weeks ago, where he's like, yeah, Michael, I just got laid off, and I didn't go apply for unemployment after I got laid off, but because they had a 6-figure savings, and that's beginning to dwindle down now. And it was a tough conversation to have, but then it's like, you know what, maybe I need to go get a HELOC because I'm not selling my house. My house is worth $1.8 million. Remember, this is San Diego County, and I only owe $1 million on it, so I've got plenty of equity. I think I'm going to rent my house before I do that. But in that meantime, is there a way for me to qualify for a home equity line of credit before I go refinance? And I'm like, I don't know. Let me ask you a few more questions. And so I think those are the types of conversations originators are going to need to have. Of course, it's tough for him to get out the HELOC. He doesn't have a job right now. But I just want to give that some closure to that story. But I think that these are tough conversations that we need that originators or
sales calluses, they call it. Like the number one problem with the mortgage industry is the cash out refinance sales muscles are so weak. And if you took out the call centers, like the banks, Bank of Omaha and BKC, SoFi, they're really weak. I don't know what IMBs are doing about it. That's what Adopt the Brand does, by the way. Adopt the Brand now has a holistic approach where we tell you to forget about what your loan officers have done till now as far as strategizing goes. We take a look at, you can anonymize it, your loan officer's production, and just separate them into who actually does purchase business through referrals, when we have solutions there. The ones that don't have to become really cash out refinance, and we give you sources, data, and exclusivity on places that are converting for those bigger companies.
sure.
And we give you a chance to be in on something huge if you really want, involving an original shark from Shark Tank with over $4 billion in sales, who wants to pump it up here in this market. And then we give you some operational efficiency ways to get it down to about 20-25 bips a closed loan, because you are going to get more business. And then we offer the first 2 months of free consulting to implement it. Even though there are, people we're referring in, we have, for example, a solution where you can build the file as it goes. It's priced less than anything. It's at 99% accuracy, and it classifies your documents, fills out the data. For the first 2 months for free, we're there to even help you implement that so that it just gets off the ground. And maybe you don't need our tech support. Maybe you just need us to be the good cop, bad cop. But it's what the industry needs, I guess. So like, they have weak muscles. They don't just need a gym membership. They need a personal trainer. With that said, and that's the plug, people are also asking, like, with all the repurchases, things sitting on the warehouse line, what can they do with it? No one's more connected into the secondary market as Michael. Michael, what?
I'm the most non-secondary person that you'll ever meet at a trade show.
Correct. So what are people doing with the repurchases? Like, I heard somebody has to repurchase one. It's a $400,000 loan. It appraises for $1.2 million. It's from 3 years ago. Fannie Mae's giving it back, and the person hasn't paid in a year. It's going to sit on his warehouse line because it's his first repurchase in a while.
That's right.
So obviously we have a talk with like this often, but what I usually just refer it over to you and your group. What
It's going to depend upon the size of the independent mortgage banker. For some IMBs, keeping a $400,000, if it's all, remember the default ratio overall is pretty small. We're not going to see a whole bunch of loans that haven't made a mortgage payment for 12 months. So if it's only going to be a one-off, two-off, you're a larger IMB, and it's only one $400,000 mortgage loan, or one $250,000 loan, or one $600,000 loan. It's not. I think you'd rather pay the higher interest rate on it, potentially. And of course that also depends on whether you decide to scale and reduce your warehouse lines of credit, whether you've it just depends on what your IMB has done, right? So, I mean, you're asking for what do I do? I've got this financial situation. What do I do? I'm like, just like any other business or any other household, you're going to sit there and go, well, it just depends on your situation. Most companies right now have the ability just to keep that one loan on their line and pay the interest on it. They don't want to pay the interest on it. I get that, but if that means taking $400,000 out of their current liquidity and to buy it and then service it, maybe they didn't reduce their lines of credit yet. Maybe they want to at least consider that. Maybe it will look better to their creditor or their correspondent relationship, and that depends upon, of course, how much in deposits are they putting in with their correspondent relationship or in the bank account. So it's going to be a lot of different factors that are going to you can't. There is no one size fits all answer.
I'm hearing there's a lot of acquisitions of companies doing 80 million a month, acquiring $40 million companies for their Ginny licenses. Is that because sort of what Sue said? You're going to. By the way, here is a tip. One group that I'm speaking to that is anti, cash out, refinance, whatever, totally purchase, always 80% purchase, always buys $250,000 worth of leads a month.
Are they buying credit score leads, or meaning the trigger leads, or are they just buying leads in general from
with Zillow? There's minimums. So in February, he said he got $90,000 worth of Zillow leads, and he really only wanted 40, but they said, well, then we'll shut it off. And then this month he doesn't want any, and he got a ton, or the opposite. So, but the point was, he looked, and not only was his top performer 60 units for cash out refinance, this branch, they can't buy any more leads from LendingTree for cash out refinance. So that's where I'm helping, with that connection. But they're the most profitable loans. They close the fastest. They're closing. So but also what he wanted to point out is he totally lost sight as an owner that the LTVs are so good in this country that some of them 61% DTI that FHA is approving a back end because the equity's there. And so I think that's why people are going out and getting these Ginny licenses, because what Sue was saying is people get in trouble. They can qualify easier for that loan to get out of it. We better stock up on those licenses if we don't have it. And I was hearing that from some warehouse people. I'm heading out to Digital Mortgage next week. So
okay. What is that about, by the way?
Well, it started back in 2017 in San Francisco, and it was one of the most amazing conferences, honestly, I've ever been to. And it was 90% lenders that really wanted to change, anything or everything. They were open to it all. What ended up happening, though, was word got out how great it was. And like any great party, the second year, it was 90% vendors and 10% lenders. And then I think 2 years ago, in 2018, the industry was just getting contracted a little bit. I think it was a rough year before COVID. And then, so it wasn't as great of a turnout. And then COVID happened. And so it, at one point, was the best conference out there. It now is one that I think some people in the industry look at as oh, it's all vendors, right? Because the lenders make the world go around, because that's where the money comes from. But overall, it's where you're going to see the more cutting edge technology the best of the best, the people that can afford to be there. And you see a lot of banks there. So like a Citizens, a Huntington, that seems to be the conference they go to versus I think it's because they get like those news, the Mortgage News Daily has different banker editions. I think that shows up in the bank versus like the MBA annual. You would think they would go to the MBA Tech Conference, Mortgage Bankers Association Tech, but this digital mortgage seems to be very heavy on the larger companies. My goal there is, again, what Adopt the Brand does, which is just find the differentiators like my client Red File and have these, I just don't think C-Level has time to be on a bunch of demos right now with volume where it is. So I'm trying to save all that time. So I'll be out there. I'll be interviewing these vendors and trying to figure out what's vaporware, what isn't, and why on earth should somebody even be interested in, signing up right now. I might actually even be on a plane next week, so we might even need a special guest. But I'll get back to you on that one. But we will be here no matter what. We'll find somebody else, but we'll be here no matter what. Next Thursday at 2 p.m.
Okay. Yeah, I mean, I just got back from the Information Network multifamily conference, and 2 weeks prior to that was the Information Network distress note conference, distress note in mortgage and real estate, of course. And it's interesting, at the distress note conference, there was a ton of mom and pop shops looking to buy distress notes. And then I was there representing the family offices for us. And I'm saying, oh, yeah, well, I've got some small regional banks that want to sell some notes. And everyone's like, okay. And I was like, it was funny because everybody wanted to buy notes. It's like the one room in the entire year where you actually see people who want to buy either low yielding paper or some kind of paper, kind of banking on what's going to happen in the future. And then of course, I was just at the multifamily conference, and usually that's about what do we do about tenancy laws. Increasing the capacity to go buy more multifamily. In this particular conference, it was more of a how many more units can we build? Can we add ADUs to apartment buildings? And is it going to be easier? So instead, if we don't have the ability to have permits to build an additional 8 units, 4 units, 12 units, 25 units, or whatever, do we have the capacity to add another 4 ADUs? Okay, well, what can we turn our current carport or garage situations into ADU situations? And that was interesting to see that they're looking to take on that some of these operators, whether small or large, are looking to do more conversions or take on some debt, higher interest rate debt, so that they can make improvements. The really interesting topic of conversation: one owner operator who has over 1,000 doors says that his typical lipstick on a pig remodel was $5,000 a door per paint and per exit strategy per new unit, and he's in the California market, and his new cost is between $40,000 to $70,000 per lipstick on a pig. And it was just interesting that they're looking for capital, high interest rate capital, in either bridge seconds on multifamily or looking to refinance even some of their commercial first trust deeds, so they can get capital, so they can make improvements to increase their rents. So a lot of stuff that's going on in that multifamily space as well. And I have a meeting next week with the MCT of commercial mortgages. So I'll report on that maybe next week, depending upon who our co-host is.
That's awesome. So how big was the conference? I mean, is there mortgage lenders there, IMBs, or like that realize
I didn't
that maybe
see that. I expected it to be vendor central, like a lot of the MBA meetings that you and I have attended in the past. But I was surprised. It's a $2,000 ticket, so I was surprised to see how many people were actually there. That was not vendor. They were actually there as like business consumers, meaning that they're businesses, but they're there as consumers. And I was pleasantly surprised to see that as a change, not only in this show, but the previous show. So there are definitely small business owners right now, mom and pop stores that might own a few hundred doors and apartments that are out there going to these trade shows or note small mom and pop holders where they maybe own a few hundred mortgage notes, and they're going to these shows and they're interested and they're going to be buying. And there are a few large institutions even that I think that even some capital markets teams don't know yet that are going to be looking to make some purchases on some of that. You know, we talked about that $400,000 loan that they're keeping on the line, and maybe they even will pay a higher price than some of the IMBs are even looking for, but they don't know to ask, or they don't know who to ask. You know, you don't know what you don't know. And I don't think a lot of people, if you're in the same fishbowl, and then there's a fishbowl up in top because, you know, someone added, you know, because the owner added something to it, but you don't know because you're a fish, right? You don't know that somebody added a new fishbowl up in the top of the aquarium, then you don't know to look for that, for what's going on. And I think that is what's going on now, that there are additional fish bowls that are being added to the space that capital markets just are not aware of just yet.
I think I'll just say, I just looked at the schedule. I will be here next. I mean, I'll be in Vegas. I'll be at the airport, and I'll give the best digital mortgage recap you've ever heard next Thursday. The MBA annual is in Philadelphia. I'll be at Housing Wire annual, then the MBA annual. You talk about vendors. It is. I just talked with a COO from big company in the Midwest to get on his, but he's like, "Yeah, I'm filling up." The list just came out last week, so everybody's going to come into Philadelphia. We can talk about. We'll talk some conferences next week, and we'll get some. We're going to have some interviews next week. I promise.
Cool.
And we'll make it, you know, on Discord, loan officer centric, and help bridge the gap between digital mortgage and the loan officers. So thank you everybody for joining.